Hi everybody, and welcome back to video number 3 in chapter 22. And when we left off, we were doing the second part of determining cash flows from investing and financing activities. And under step 3 here, we're determining the cash flows from those investing and financing activities. After we have determined the items affecting net cash provided by operating activities, then the next step involves analyzing the remaining changes in the balance sheet account. Evergreen Incorporated analyzed the following accounts. Number 1, the increase in land. The company purchased land of $70,000 during the period. This transaction is an investing activity as it involves long-term assets, and it's reported as a use of cash or a cash outflow. Number 2, an increase in building and the related accumulated depreciation. As indicated in the additional data and from the change in the building account, Evergreen acquired an office building using $200,000 in cash. This transaction is a cash outflow, and it's reported in the investing section as a long-term asset. The $11,000 increase in accumulated depreciation results from recording depreciation expense on the building as indicated earlier. The reported depreciation expense has no effect on the amount of cash. Number 3, the increase in equipment and related accumulated depreciation, also long-term assets, reflect an increase in equipment of $68,000, resulted because the company used cash to purchase equipment. This transaction is an outflow of cash from an investing activity. The depreciation expense entry for the period explains the increase in accumulated depreciation equipment. And number 4, an increase in bonds payable. The bonds payable account increased $150,000. Cash received from the issuance of these bonds represents an inflow of cash from a financing activity. And number 5, an increase in retained earnings. Retained earnings increased $116,000 during the year. Two factors explain this increase. 1, net income of $134,000 increased retained earnings, and 2, dividends of $18,000 decreased retained earnings. Payment of the dividends is a financing activity that involves a cash outflow. Okay, here is the statement of cash flows for Evergreen for 2025. Using the indirect method here, we're talking about cash flows from operating activities. Here's net income and the adjustments we make for non-cash expense, dividend expense. And then we look at the changes in current assets and current liabilities. And here we had a decrease in accounts receivable, an increase in prepaid expenses, and an increase in accounts payable, for a total adjustment of $60,000. So our total cash provided by operating activity are the sum of the net income plus the adjustments, or $194,000. For investing activities, we spent $70,000 on the land. We purchased a building for $200,000, and we purchased equipment for $68,000. So we had net cash used by investing activity of $338,000. Then from a financing activities, we issued some bonds for $150,000 and paid dividends of $18,000 for a total cash provided by financing activities of $132,000. So in total, all three of the activities here total $12,000 decrease in cash. Our starting cash position at the beginning of 2025 was $49,000. So subtracting $12,000 from $49,000 gives us $37,000 cash balance at the end of 2025. Now, so we look at these comparative balance sheets for 2026, and we have our current assets and other assets and liabilities increase and decrease here. Give you a chance to look at those. Okay, and here's the income statement for 2026. We have revenues here of 890,000. We have our normal cost of goods sold, operating expenses, interest expenses, loss on the sale of equipment, a non-cash loss, and income from operations of 190,000. We pay tax of 65,000, so our net income is $125,000. Additional information very important in calculating financing and investing activities. We see that operating expenses include depreciation expenses of 33,000 and the expiration of prepaid expenses of $2,000. Under Bravo here, land was sold at its book value for cash. Charlie, cash dividends of $55,000 were declared and paid. For Delta, interest expense of $12,000 was paid in cash. For Echo, equipment with a cost of $166,000 was purchased for cash. Equipment with a cost of $41,000 and a book value of $36,000 was sold for $34,000 cash. For Foxtrot, bonds were redeemed at their book value for cash, and finally Golf common stock was issued for cash. Okay. Step 1, determine the change in cash. The first step in the preparation of the statement of cash flow is to determine the change in cash. And as the comparative balance sheets show, cash increased $17,000 in 2026. So if I go back here, we can see that $17,000 here from 25 to 2026. Okay, the next step is to determine the cash flow from operating activities using the indirect method. So we're going to pick up $125,000 from net income on our income statement, as shown here. And we have 5 adjustments here that we're looking at. We have an increase in accounts receivable of $42,000. We have an increase in inventory of $54,000. We have a decrease in prepaid expenses of $2,000 and a decrease in accounts payable of $7,000. And depreciation expense, we have buildings increase $10,000 and they recorded depreciation expense of $10,000 in 2026. And we get all those numbers from our comparative balance sheet here for our current assets, not including cash, and our current liabilities here of accounts payable. Okay. Also, our accumulated depreciation on buildings here shows us that we had a $10,000 increase in depreciation for buildings and an $18,000 increase for equipment, which we indicated. Okay, So accumulated depreciation for equipment increased by that $28,000 during the year. But two items caused that change. One, here, the sale of equipment, and two, the recognition of depreciation expense. So the calculation is a little complicated. The additional information stated that the sold equipment had an original cost of $41,000 and a book value of $36,000. The $5,000 difference between cost and book value is the amount of depreciation previously recorded for the equipment. So, since the equipment is being sold, accumulated depreciation dash equipment decreased by $5,000. With some calculation, it is determined that depreciation for the year was $23,000. The company reconciled the accumulated depreciation equipment as follows. Here's our beginning balance of $10,000. We added depreciation for 2026 to get to $33,000. Then we deducted the sale of equipment for $5,000, giving me an ending balance of $28,000. So the company must add back to net income the total depreciation of $33,000. That's the $10,000 from here. Building depreciation, and then the $23,000 for 2026. So that's a total of $33,000 charged to the income statement. And that's going to be an adjustment to the operating activities. The loss on the sale of equipment, Evergreen sold for $34,000 equipment that cost $41,000, and it had a book value of $36,000. So there was a loss of $2,000, the difference between book value and what it was sold for. So the company reports a $2,000 loss on the income statement. To arrive at net cash flow from operating activities, it needs to add back, as we would with depreciation, the loss on the sale of that equipment. The reason is, of course, that the loss is a non-cash charge to the income statement, as is depreciation expense. The loss did not reduce cash, but it did reduce net income. Okay, so here's our net income, our depreciation expense we're adding back, the loss on the sale of equipment we're adding back. Then the changes in our current assets and current liabilities are shown here. And the result is a deduction of $66,000 in total, giving us net cash provided by operating activities of $59,000. Now, land decreased $25,000 during the period. And as indicated from the additional information, the company sold land for cash at its book value. So that's pretty easy. That represents a $25,000 inflow of cash. The equipment account, we had a beginning balance of $68,000. We purchased $166,000. So in total, we had $234,000, and then we sold $41,000 worth of equipment, giving us an ending balance of $193,000. When the company used cash to purchase equipment with a fair value of $166,000, an investing transaction is reported as a cash outflow. When the equipment is sold, the equipment account is credited for the original cost of the equipment. But remember, the statement of cash flows, the cash received from the sale is reported, not the original cost or the book value. Evergreen reports the sale for $34,000 cash as an investing activity. This looks like a good place to stop this video, and when we return, we'll continue on with this example. Until then, bye for now.